Professors FM.
I'm Bridget Stomberg.
And I'm Lisa DeSimone.
And this is Taxes for the Masses.
Today's episode is on the Tax Cuts and Jobs Act tax cuts that are currently set to expire in 2025.
The Tax Cuts and Jobs Act of 2017 was a signature piece of tax legislation from President Trump's first term in office. Many of the act's beneficial provisions are set to expire at the end of 2025. In early 2025, House Republicans passed a budget plan that calls for $4.5 trillion in tax cuts, many of which are extensions of expiring TCJA provisions. In today's episode, we discuss the source of the tax cuts and present estimates of who would likely benefit most from their extension.
Hello, B.
Hello, Lisa.
I kind of feel like I haven't seen or talked to you in like forever because you missed another tax conference because you had basically no voice and then you got COVID. Please stop.
Yeah, not fun. Don't like it. I think I counted it up and I was healthy for 9 days in February.
Yuck.
Yeah, it wasn't great. So I think it's safe to say by all accounts that I'm allergic to something and I'm going to call it 2025.
Okay. I could have told you that.
I think that's the root cause.
Okay.
But yeah, I'm not going to lie. I was disappointed because the COVID finally got me for the first time after pretty much 5 years of successfully dodging it.
That's impressive. I thought I had the record because I think it took me maybe 3 years to get it before I finally got it. And now I've had it twice.
Yes. You're making up for lost time.
I made up for lost time. But yeah, you went 5 years to the point where nobody even really cares that much about COVID. No. Congratulations.
You are so right. Don't get COVID now because nobody cares.
Nobody cares. But people do care about taxes, I think.
This is news to me. You and I care about taxes.
The government cares about taxes. The politicians who are talking about tax reform again.
Yes.
Seems to be a hot topic.
Yes. Maybe cutting taxes.
Yes.
Okay. There we go.
So yeah,
I can get behind that.
I'm trying to make you feel better here. I'm trying to give you something to look forward to in 2025, which is that people are talking about extending the Tax Cuts and Jobs Act, which is going to expire at the end of 2025 unless Congress takes action.
That's true. And so I think what you're saying is that despite all the talking that we have already done about the Tax Cuts and Jobs Act, we are going to talk yet again about the Tax Cuts and Jobs Act.
Yeah, I don't think we've talked about it enough already.
Apparently not.
Okay. So our mission with this podcast, as our listeners know, is to break down taxes, the topics that are in the news. And the extension of expiring Tax Cuts and Jobs Act tax cuts is all up in the news right now, maybe dominated by a little bit by tariffs, but
fair.
But it's still up there.
For example, in February 2025, the House passed what they are calling a, quote, budget blueprint that is paving the way for $4.5 trillion in tax cuts. And because when you cut taxes, you cut government revenue. So it's also calling for spending cuts. Do you want to guess how much spending cuts? Because if we're going to cut $4.5 trillion in revenue, then what would you think that we should cut in terms of spending?
I mean, I would hope with an entire department of the government dedicated towards cutting government spending, that it would more than offset. But I know that cannot be true.
You know better than that.
Yes.
$2 trillion.
Okay.
Yes. So we're only going to increase the deficit by 2.5 trillion. So that's good.
All right. Yeah. So as you pointed out, 4.5 trillion of revenue cuts, which is what tax cuts are, is bigger than the 2 trillion of spending cuts.
Yep.
Question for you.
Yes.
What the hell is a budget blueprint?
It's an excellent point on the spending cuts being smaller than the revenue cuts. As business people,
I think that was your point.
That's not great. You agreed with me. So good job agreeing with me on that point.
I sheep-heated you.
Thank you.
You're welcome.
What is a budget blueprint? I think it's an excellent question, and we have to be really specific with our language as we record this episode because this is not an actual bill.
Right.
So some articles that we read are kind of referring to it as a bill. It's not a bill.
Right. Okay. There is no bill yet.
There is no bill.
Okay.
So it's just Republicans getting together and sketching out this general idea / goal of providing $4.5 trillion of tax cuts and sort of saying, like, if we're going to do that, then we should have some spending cuts. Let's cut $2 trillion of spending. So it's just a guideline.
Yeah.
They haven't built the house yet. They have the sketches
to
build the house. But that means that they are going to actually have to go through the exercise of, deciding the details required to achieve those goals and then actually passing the bill.
Okay, great. So today we are going to try to provide some structure to the blueprint by highlighting the Tax Cuts and Jobs Act provisions that are set to expire at the end of 2025, but that could be extended.
Yes.
We're then going to discuss who is likely to benefit from those extensions. And without thinking any further about this, I'm going to go ahead and say the wealthy and corporations.
Okay, keep that in mind, listeners, and we'll fact check you at the end of the episode.
Love it.
Okay. All right, so to start, first up, let's talk about the individual tax provisions that are going to expire.
Let's.
Because the TCJA had things that benefit both individuals and businesses. So we're going to start with individuals. And for that, I'm going to turn it over to you because although I'm speculating that I may be allergic to 2025, I am definitely allergic to individual taxes. So I'm just going to...
That's just lies.
I'm going to be quiet for
lies and deceit.
A little bit.
I'm not going to allow you to completely shirk on this. No. Let's start with tax rates on ordinary income, things like salaries and wages. The Tax Cuts and Jobs Act, which was passed in 2017, went into effect in 2018, lowered the tax rates on ordinary income across the board. So, for example, the top rate fell from 39.6% to 37%, which is not much of a tax cut, but it is a cut.
Yeah.
While lower rates at the bottom end of the brackets dropped from 15% to 12%. Some rates remained unchanged. No rates increased. Extending these provisions would keep these generally more favorable tax rates. Your turn to talk.
Okay, rolling my eyes. Okay, so you talked about tax rates, which I should have talked about because those are the easiest thing to understand. So you got to give the dummy the easy part of the assignment. But let's talk about the standard deduction.
I think you just called me a dummy.
No, I said you should have given me the dummy, the easiest part of the assignment. But I can talk about standard deductions.
Okay.
The Tax Cuts and Jobs Act more or less doubled the standard deduction.
Yep.
Which means that not only do taxpayers get a bigger automatic benefit, but in theory, and I think in practice, it made individual taxes less complex, at least in this domain, because fewer people have to worry about computing and claiming itemized deductions, which are traditionally for things like mortgage interest, medical expenses, or subject to limitations, ceilings, floors, what qualifies, what doesn't, blah, blah, blah. So before the act, the standard deduction for a married couple filing jointly was around $13,000, and it rose to around $24,000 under the TCJA, and it is indexed annually for inflation.
So it just keeps getting bigger and bigger every year, presumably in line with the Nutter Butters inflation that we've had.
Correct.
All right. The third item that we'll talk about is the child tax credit. The Tax Cuts and Jobs Act doubled the maximum credit to $2,000 per child. It also increased the amount of the credit that is refundable, meaning a taxpayer can get it even if they don't have a tax liability.
Yep.
It's effectively a check from the government, not just a reduction in their taxes down to zero. And that's super important for families that have no or very low income tax liabilities. And the change also increased the income thresholds at which the child tax credit phases out, meaning that more high-income families can claim the credit under the Tax Cuts and Jobs Act, but it's all set to expire.
Yes, so those are the three individual provisions that are set to expire: the lower rates, the higher standard deduction, and the sort of supersized child tax credit. Now, thankfully, we can move on to the business side of things. Can I do that?
Is this your happy place?
I'm happy now. Thank you. So on the business side, it's likely that any Republican budget bill would restore 100% expensing for qualified business assets, things like machinery and equipment, and also allow companies to return to immediately expensing their research and development charges. The Tax Cuts and Jobs Act allowed for immediate expensing of business assets for 5 years after its passage, and then the percentage of the purchase price that can be immediately deducted has sort of been stepping down by 20% a year. So right now in 2025, companies can immediately deduct about 40% of their qualified business asset purchases. So that was on the asset side. And then as far as R&D is concerned, the old law was that companies were allowed to immediately expense their research and development, their R&D. But as of 2022, companies are now required to capitalize and amortize their R&D expense over a 5-year period. That was a lot. Can we have an example?
That's a lot. Yeah, we need an example.
Let's do an example.
Okay, so let's assume we purchased $10,000 of high-tech podcasting equipment.
Ooh.
We're really up in our game there.
Yes.
And we incur $5,000 of R&D, research and development, related to podcast process optimization.
I am intrigued by this.
I don't even know what these words mean.
Sounds fancy.
Just play along.
Okay.
Under the current rules, and ignoring, a few carve-outs for small businesses, which our podcast would surely be classified as, we're just sweep that under the rug. If we were a larger business, we could immediately deduct 40% of the equipment this year, which is $4,000, right? 40% of $10,000.
Yep.
And then 1/5 of the research and development costs, or $1,500 of $5,000 of our total R&D costs related to podcast process optimization.
Yes. Mm-hmm.
Okay, assuming a 25% marginal tax rate, those deductions would produce a tax benefit of $1,250.
That's good.
It's not bad.
No,
I mean,
I
I'd
like
take
it.
$1,000. With immediate expensing of both assets and R&D, however, we would be able to deduct the entire $10,000 of expenses plus $5,000 of R&D, so $15,000 immediately expensed for our tax return, with a tax benefit of $3,750.
That's more better.
It's way more better. It's 3 times as better.
Mm-hmm.
Exactly. Yes. Quicker expensing yields greater tax benefits generally, not just in our little specific example here. And those benefits increase with the taxpayer's marginal tax rate.
I like that point. I just want to make sure we're all listening to that. It's a good point. The higher your tax rate is, and your tax rate is tied to your income.
Yes.
So the more income you make, the higher your tax rate is, the more you benefit from $1 of a deduction.
Always going to be true.
Just saying. Another TCJA provision set to expire, or what we like to call sunset. It's very gentle. I like it.
It is.
Picturesque. It's the 20% deduction, everybody's favorite 20% deduction for qualified business income earned by owners in certain pass-through entities. I'm not even going to try to summarize that because it's one of the more painful and complex provisions.
Yeah, that one would take an entire episode to try to summarize.
Good news, we have one.
Yep.
Go check it out, because we're not doing that here.
And lastly, some of the details of the new international provisions of the Tax Cuts and Jobs Act, things like the foreign derived intangible income and global intangible low tax income deductions or penalties. They're also very painful to explain, so we're not going to explain them here, other than to say that they were intended to try to get companies to relocate their intellectual property back in the U.S. and not in tax havens.
Absolutely. Carrots and sticks.
Yes, and those carrots and sticks are set to change and become far less beneficial in the case of the carrot of bring your intellectual property back to the U.S. and we'll give you a deduction for it.
It's going to become a baby carrot.
It's going to become a baby carrot, which is not actually a separate species of carrot.
No. Just a
Right.
peeled big carrot, right?
They're just cut into smaller pieces.
Yeah. Shocked when I learned that.
The other one is also set to change, the more punitive guilty one, which actually imposes a tax on your foreign earnings to the extent that it's believed that those earnings are held in low tax jurisdictions and were generated by intellectual property. So extending these would keep the net effect of these provisions at their current levels for businesses.
Okay, so that's pretty much it for the expiring TCJA provisions, a couple affecting individuals, a couple affecting businesses. And what we're talking about here is things that are generally taxpayer friendly, right? Lower tax rates, higher standard deductions, more immediate expensing.
Most of them, yeah.
So anything that we do to extend these provisions is going to reduce federal tax revenue.
That's exactly right. Yeah. The Tax Cuts and Jobs Act was passed under the budget reconciliation process, which very, very loosely speaking means that the favorable provisions of the act could not increase the deficit over a 10-year window.
Correct.
And that, my friends, is why so many of the favorable provisions are set to expire at the end of 2025, before the end of that 10-year window. If those cuts had been permanent under the initial passage of the act, they would have been too costly to have passed the act with the budget reconciliation process. And because the Republicans basically got no support from Democrats in passing the Tax Cuts and Jobs Act back in 2017, the entire bill likely would not have passed.
All right, we've outlined some of the new and continuing tax cuts that are likely to be considered in any Republican tax bill that comes out of the House. Now we're going to address our second goal for today, which is to talk about who stands to benefit, mostly from the expiring TCJA provisions being extended.
Yep. And I have already given my thoughts on that, but this is important because, as you might expect, not everybody sees it as clearly as I do in their predictions. There's definitely some disagreement over who might benefit.
I would say that's putting it mildly.
Okay.
So Representative Richard Neal, who is I'm not going to say, you get to decide his political affiliation after I give you this quote.
Okay.
He's ranking member of the House Ways and Means Tax Committee, and he claimed that extending the TCJA cuts is, quote, a reverse Robin Hood scam, end quote, taking money from the poor to give it to the rich. So,
sounds like a Democrat to me.
You nailed it. And on the other side of the aisle, Representative Jason Smith, who is a Republican from Missouri and chairman of the House Ways and Means Committee, said that, quote, extending the Trump tax cuts delivers the biggest relief to working class Americans and small businesses in a generation. So safe to say they are not seeing eye to eye on this.
Yeah. So that makes it super clear for the American people.
Yes.
So who's right?
Mm-hmm. Yes.
Well, as with many complicated things, there's probably some amount of truth to both statements. So let's try to break it down. One of the benefits we have in this scenario is that the Tax Cuts and Jobs Act cuts are already in place.
Yes.
So we can use some historical data to see who benefited from them.
Yes. Yes.
We'll also rely on estimates from the Penn-Wharton budget model and the Tax Policy Center to estimate future effects.
Okay, so I love that. And we're going to start by looking backward because that actually happened and it's a thing. So who benefited from the TCJA? Well, truth is it benefited everyone.
Everybody wins.
Everybody wins.
Everybody gets a car.
You get $1 and you get $1 and you get more than $1. So it benefited everybody, but not equally. This was not the Oprah show. Everybody did not go home with the same prize. So according to work by William Gale and others for the Tax Policy Center, the Urban Institute, and the Brookings Institute, 84% of taxpayers in the top 0.1% of the income distribution, so the tippy top earners, got a tax cut from the TCJA, with the average tax cut in that group being over $280,000.
That's a lot of dough.
In contrast, only 54% of taxpayers in the bottom 20% of the income distribution got a tax cut. And on average, that tax cut was $130.
Cool. So the tippity top could buy a house in many areas.
Yes.
With their savings. Annually, I'm assuming.
Yes.
Whereas the bottom of the distribution could go out to dinner.
At some restaurants.
At some.
Not all.
Not all.
Correct.
Okay. The other estimates tell a similar story. Obviously, these are all rough average calculations, and the actual effects of the Tax Cuts and Jobs Act varied for each household depending on the facts and circumstances. But in general, across multiple estimates from multiple sources, all taxpayers did benefit from the Tax Cuts and Jobs Act, but high-income individuals benefited more.
Okay, so that's a look backward, but let's not, tie ourselves to the past. Let's be forward thinking.
Okay.
What happens if we look forward?
I'd say if we look forward, we would expect similar trends.
Okay, I tried, listeners. I tried.
Okay. Let's actually go to the data. The Penn-Wharton model estimates the Trump administration's tax proposals would once again increase after-tax income throughout the entire income distribution. That's a good thing. But once again, the effects are concentrated among the highest earners. For those making around $64,000 each year, after-tax income would increase by about $2,200 or 2.6%. For those making around $400,000 each year, the after-tax income would increase by about $32,000 or 5.3%.
Okay, so the disparity is still there, but I like the raw numbers a little bit better.
Yeah, it's better than $280,000 versus $130.
Okay. I mean,
yes.
$2,200, in all honesty, can probably get an entire family of 4 into Disney for the day, and you might even be able to stay. You're gonna stay over
one day.
You're gonna get a hotel out of that, flights. I'm throwing it all in.
Good
yeah, 4
grief.
days, 4 park hopper tickets is gonna set you back about $1,000.
I'm just going to focus on the positive here that you found a benchmark that entertains you.
I hope it entertains someone else, but yes, I am very entertained.
And clearly you've done a lot of planning for going to Disney.
Perhaps. Yes. It's when all this education stuff falls apart, that's going to be my new full-time job. We should also mention that analysis by the Tax Policy Center estimates similar distributional effects looking forward as the Penn-Wharton model does.
But these estimates consider only $4.5 trillion of tax cuts. Remember, those are paired with $2 trillion in cuts to spending.
Which, wait for it, also affect human beings.
Yeah. Yes. Especially if you cut things like Social Security and health insurance.
Healthcare, yes.
So this is where the Penn-Wharton model does something that's really pretty cool.
Yes.
And we strongly encourage listeners to go check it out. What they do is they estimate the amount of money that would make someone indifferent between passing the reform or not, taking into account both the tax cuts and the spending cuts.
I thought this was a very cool way of looking at things. So let's look at 2 examples from their data.
Okay.
So a person in their 70s,
My parents.
yes, our parents, who are in the highest quintile of the income distribution, would be indifferent between these TCJA extenders and a one-time payment of about $114,000.
Okay.
So what that means is that the cuts to tax and the cuts to spendings are going to benefit them on net by about $114,000 for the rest of their lifetime.
Okay. Even people in their 70s who might get cuts to services that
Medicare, Medicaid.
they care about, Social
Now,
Security.
Remember, these are 70-year-olds in the highest quintile of the income
Fair.
distribution. They might have
Private
insurance
insurance.
and things of that nature.
Okay. Let's turn instead to a person in their 20s in the middle of the income distribution. So not 70, but 20, and not in the highest quintile of income, but in the middle of the distribution.
So much like our recent college grads.
Sure. They would be willing to pay $900 to have the cuts not be extended.
So they would actually be willing to give the government money to not pass it.
To cut all of this chatter
Yes.
about extending everything and say, please spend your time doing something else.
Yes.
We will pay you $900 each to do that.
Because if you actually do all of this stuff, it's going to hurt me to the tune of $900. I am indifferent.
Yeah.
So, dear listeners, as with many things, taxes, it is complicated. But punchline here is you really have to take what both sides are saying with a hefty, I'm going to say a spoonful of salt, maybe.
Yes.
Like not just a grain, I don't think is going to cut it. You really need to get under the hood and figure out how much tax the bill is going to save you and whether you think it's worth it in light of the costs to you and to others.
True.
All right, time for the good, the bad, and the ugly, and I'm going to kick it off.
Okay.
I'll even say something good,
Amazing.
which I bet surprised you given how kind of bleak this episode is. But I am not currently ill.
And you're currently sitting in the same room with me, which is always lovely.
Not giving you an illness.
Not giving me the COVID.
It's so good.
It's so good. I'm also going to say that these models, especially the ones that take into account the effect of the tax cuts
Yes.
and the spending cuts,
Yes.
they're super cool.
Yeah, I had never seen anything like that. They break it down, by age, by income distribution. They do one with just the tax cuts, and then they do one where they rope the spending into it. I think it's pretty cool. And I know sometimes people can get intimidated by statistics and numbers and things like that. It's pretty accessible, I would say.
Yeah, it seemed that way to me.
Yeah. So
Yeah.
I definitely, encourage people to go check that out. And I don't want to say anything else good about any of this. So.
Okay, so let's go to the bad.
Okay. I guess if I could put it bluntly, I'd say this is all fake.
Say more words.
So you've mentioned this before, and I'm starting to totally understand what you mean.
It's only taken years.
You get to things faster than I do sometimes. The politicians had to make the Tax Cuts and Jobs Act cuts, quote, temporary.
Oh, yeah.
Right? Because they couldn't increase the budget over a 10-year
and pass the bill
window and pass the bill. So it's like, okay, we won't do that. It's just going to be temporary. It's just going to be for like 8 years, right? And then all of the stuff is going to expire. But they're not really temporary if we're just going to extend them again for another 8 years. All of these estimates go out through 2033. It was just all one big fake game.
Yeah, but everybody knew it was fake at the time.
I know. Did we?
Yeah, because the whole point is that it's very difficult to let benefits expire for people. This is why they're going to have a hard time, I think, cutting things like Social Security.
You would hope.
Once you're giving people something, it's really hard to take it back.
Yes.
And so I think the strategy was, we're going to pass this bill in the only way we can, which is through budget reconciliation. And so we have to have that 10-year window. We have to make it expire. And we're going to basically make the Democrats call our bluff that, they're going to actually let it expire and take these benefits away from people. I don't think there was any ever expectation that these wouldn't get extended in some way.
So it's just a big game of kick the can, because extending them is it's gonna hurt. There's no such thing as a free lunch. I remember somebody saying one time that no bill is revenue neutral, right? Like somebody is going to win, somebody is going to lose.
That's true.
It may not increase the deficit. This one will increase the deficit. But even if something truly doesn't increase the deficit, it doesn't mean that everybody wins.
Yeah.
Also, just like the whiplash that all of this induces, we get. Because you're right, nothing really ever expires, and if it does, it usually gets instated retroactively.
Yeah.
Right? We think about tax credits that expire, and then they just say, oh, we'll pretend it never expired.
Yeah.
So then I don't know. I just feel like it's this, we're all going to get really panicked and uncertain about whether something is going to get extended, and then it gets extended, and then we all get really upset and uncertain about whether can we stop? It's tiring.
It is tiring. I agree with you. It's not good policy to have all this uncertainty. I mean, everybody kind of knows that it's going to get extended in some way, shape, or form, but we don't really know for sure.
No, and you're not going to take the word of the government.
Right. Yeah, I would say another bad. It just, it's the accountant in me, I guess. It troubles me to have everything so unbalanced. Right, we're getting a huge decrease in tax revenue at the same time that we're decreasing spending by less. And as a result, like they're trying to make it sound like, oh no, we're cutting spending. Yay. We're making this all good. No, you're increasing the deficit by trillions of dollars. Trillions.
$1.8 trillion is what we've got baked into $1.8 trillion.
It's mind-boggling to me.
It is. I read an article one time, and that's a lie. I read the headline of an article one time, that when you're talking about things like trillions of dollars, like people just can't understand what that means.
Agreed.
And I think that that's kind of hurting us in this situation, because we're just so desensitized to what that number means. It's like, oh, sure. Like, it's not $1.70, right?
Yeah.
It's huge. And I don't know, maybe it will never matter, but it feels like it's got to matter at some point in time.
I mean, that kind of relates to what I think is the ugly part of all of this, which is that, like, who really cares if we understand what $1.8 trillion is? We're going to ignore the facts anyway and just push our own agenda and say, no, yes, this benefits everybody and everybody wins. Well, yeah, it does. But as you said, a bill is never going to affect people across different walks of life the same way. There's always going to be winners and losers. So yeah, it would be nice to be more transparent, but we're not going to get that. We're not going to even get people focusing on the facts. We're going to get people saying whatever they think sounds good that they think their constituents want to hear.
So if I could say anything to listeners, it's that most of the highlights we found and most of the estimates that we found when researching this episode focus on the tax cut. So if a politician is saying to you, someone who's making $65,000 a year, your tax bill is going to go down $2,500. That's great. However, if it also means that you're losing your health insurance, or that your child is no longer going to qualify for a reduced lunch, or that the post office isn't going to exist and you're going to have to use UPS to do everything.
Yep.
After all of that happens, are you really going to have $2,500 extra dollars? And the answer is maybe not. And that's the number that you should be focusing on, not the top line tax cut number. It's how this is affecting you net of the spending cuts.
Yeah.
And we know that those also are going to be disproportionately affecting,
of course,
the lower parts of the income distribution.
So how many more days in 2025?
Yeah, it's a lot.
Stay tuned to see what happens with this interesting budget blueprint that we've talked about. Well, that's all we have time for today.
Be sure to join us for more tax nerdery on future episodes of Taxes for the Masses.